Great to have you here with us, Scott. So first and foremost, as I was looking through some of the numbers here, confidence ticking higher in July. I want to get your overall reading on this most recent Conference Board report.
Yeah, well, first of all, good to be with you, Brad. Thanks for having us. I would say that this is really more of the same. When you look at the data over the recent months, yeah, a little bit higher than expected, but it's continuing this trend of, hey, the economy is slowing, but it is still growing, and consumers are still spending money. Consumer spending is beginning to tick back up after dragging for a few months. So we're seeing consumers feeling pretty good about their bottom line. And obviously, it all goes back to their personal economy versus the economy. When they answer that question, how do you feel about things? They're going to be looking at their own bottom line. And that really says to me that their incomes are strong. Wage growth is pretty strong. They're still spending money. They feel pretty good about where they are.
Yeah, it's really interesting. We saw, at least in one of the quotes from Dana Peterson, the chief economist over at the Conference Board, saying that confidence did increase in July, not enough to break free of this narrow range that we've been tracking, really prevailing over the past 2 years. And I want to come back to what you were mentioning on the labor market and what we're anticipating the labor market will do in the continuance in the kind of range that we've seen, and if we'll break out of that range, considering the unemployment rate has continued to tick slightly higher over time here, and right now sitting at around 4%, just a little bit north of that. So all those things considered, what's the labor market going to continue to tell us about where consumer confidence moves from here?
Yeah, well, I'll put the disclaimer out there. I'm a financial advisor, not an economist, but I do read the same things probably that you do as well with regard to that. And I think it says much of the same too, a slightly higher unemployment rate. But for us to go into a recession and things to really change from a market perspective, it's going to have to climb a lot higher than what it is. If you look at history as our guide, the unemployment rate is still historically very low. And if we keep plodding along here, I think you're really starting to see, despite for the last 2 years, you see these recession calls out there. I think the soft landing is actually a pretty big reality right now. I think we're headed for that. I think inflation is down to manageable levels, not to the 2% that the Federal Reserve wants, but 3% is a historical average. Interest rates are at historical averages. We talk about them relatively high compared to where we were, but if you look at the long-term averages, this is kind of how we've operated. This is a long-term average, both from an interest rate and from an inflation number. So I believe that the American consumer can absorb this. They can continue to rock along as long as they go back to that wage growth, as long as they're working, back to your unemployment number, but also getting the wage growth that keeps up with the increase in prices. On
wages right now, on a 6-month moving average basis, consumers making over $100,000 were the most confident, but the gap with others and other groups, they narrowed here. So in terms of the financial advice that you would give to those who are in some of those other gaps where the confidence is continuing to remain within this kind of range and range bound, what would you be telling them on that kind of personal income front and personal finance front that they can deploy to be more confident, especially in a time where the readings aren't coming out, as glorious or rosy as they were in the past?
Yeah, Brad, I just had a conversation in a client meeting room just yesterday talking about the middle class, and that's where I really have some concern in the long term. I feel like we are seeing that gap widen, right? That not everybody is getting that wage growth. And really, when I talk to clients about this, it's really always coming back to creating margin in their lives, in their financial lives now, so that they can put money back and build wealth and have the retirement they want. We talk about it in terms of financial independence. It's not really retirement, it's financial independence. You may continue to work, but there's a point in the future where you have the assets and the income produced from those assets at a certain age that you are financially independent. To get there, it's more about your contribution rate than it is your overall rate of return. So you got to sock money back, right? And the only way you can do that is to have a pretty good margin between your income and your expenses. And if the income is not rising in your current job, then you're going to have to learn to lift your lid, right? You've got to look for the side hustle. Maybe we're in a gig economy, right? If you're not getting it from your W-2 job, you're going to add some 1099 income somewhere, right? Or you've got to advance in your career or start a new career, because in this world of tech, in this world of AI, computers are doing more for us, but it's still a human driving that, and there are always going to be opportunities to grow your income. And then, of course, you have to watch your debt on the downside so your expenses don't get too high, and that margin creates your contribution rate.
Scott, just lastly, we only got about 30 seconds left, but you'd mentioned soft landing seems firmly in perspective right now, firmly in view. So with that in mind, is there a soft landing portfolio playbook that investors should be considering?
Yeah, I think you still have to believe in equities for the long term in all market cycles, in all economic conditions. We tell our clients we're not looking at day trading. You shouldn't look at your portfolio on a daily basis. You don't weigh every day. Well, maybe you do, but you don't really want to weigh every day because you can get frustrated, right? So you don't look at your stock portfolio every day. That's built for the long term. That's going to be there. But I would say from this point forward, as we hit all-time highs and the length of this bull market gets longer, if you look at fixed income, if you look at the bond portfolio, you might want to go a little more overweight there because bonds have a really favorable outlook. As many people know, if interest rates go down, bond prices go up. So it could have a really big impact in your total return in that bond portfolio. So I think bonds are very favorable right now, but you still have to believe in equities for the long term.
All right, Scott Inman, Gen Wealth financial advisor over there. Thanks so much for taking the time here. We appreciate it.
You bet.